Hello, and a huge welcome to all of our beginner traders tuning in from the US, the UK, and beyond. Okay, let's dive into this. Today, we are unpacking the ultimate beginner's guide to the Forex market. So if you've been staring at charts and feeling completely overwhelmed, well, take a deep breath because you are in exactly the right place. We've got to be honest right out of the gate here. The Forex market, it's tough. It's a highly competitive, wildly volatile world. And the reality is that a majority of people actually rack up losses on their accounts during their very first year. But hey, do not let that scare you away. As you can see, this skill is completely learnable. Experienced traders have carved out a real path to financial freedom here. It just requires consistency, some serious discipline, and a genuine willingness to learn the ropes. So here is our roadmap for today. It's pretty simple. Number 1, the basics of Forex trading. Number 2, setting up your tools. Number 3, understanding price action. And finally, number 4, mastering risk and psychology.
All right, Section 1, the basics of Forex trading. Let's start building that foundation.
First things first, what actually is Forex? Well, it's simply short for foreign exchange. It's literally just the global marketplace where national currencies are traded against one another. See? Just like that, we've already demystified one of the most basic pieces of industry jargon. And this brilliantly illustrates one of the most common terms you're going to hear in the trading world: bulls versus bears. Being bullish means you expect the market to go up, so you're buying in an uptrend, which traders also call going long. On the flip side, being bearish means you expect the market to drop, so you're selling in a downtrend or going short. Keep it simple. Bull means up, bear means down. Now, when you're just starting out, you absolutely shouldn't try to trade every single currency under the sun. It's way too much. As Lit FX Academy points out, there are specific beginner-friendly major pairs you really should focus on. We're talking about the euro against the US dollar, the British pound against the dollar, and the dollar against the Japanese yen. Why these? Well, they offer incredibly high liquidity, meaning there are tons of buyers and sellers, and tight spreads, which basically keeps the cost of entering your trades nice and low. Plus, they're just way easier to track. So, when you look at a pair like the Euro-USD, how does that relationship actually work? It's like a tug of war. The currency on the left is your base currency, and the one on the right is the quote currency. If you hit buy on the EUR-USD, it simply means you expect the euro, that base currency, to go up in value and the US dollar to go down. Whatever action you take directly applies to that base currency on the left side of the slash.
Moving right along to Section 2, setting up your tools. Let's build your digital workspace.
Getting set up is actually incredibly straightforward. Step 1, download MetaTrader 5 or MT5 as everyone calls it to your phone or computer. Step 2, open up TradingView on your web browser or grab their app. And Step 3, sign up for a demo account through a broker. Listen, that demo account is absolutely crucial for beginners. It lets you practice with virtual money. You really want a completely risk-free sandbox environment while you're learning the platform and testing things out.
Now, you might be wondering, why on earth do I need two entirely different tools? Well, they have a very clear division of labor. TradingView is where you do your market analysis. It has all the modern, fancy charting tools to help you visualize exactly what's happening. But when it's time to actually pull the trigger and execute a trade, that's when you hop over to MetaTrader 5. So think of it as analysis on one, execution on the other.
All right, Section 3, understanding price action. This is all about reading the market. The absolute core of price action trading revolves around supply and demand zones. So what are these? They're simply historical points on a chart where the price hesitated and then reversed. When the price drops down and bounces back up, that creates a demand zone, which acts as a floor or support. When the price rises and gets pushed back down, that creates a supply zone, acting like a ceiling or resistance. Basically, as a trader, you are looking for a history of hesitation on the chart to give you a solid clue on where to act next.
Now, what's really interesting about this slide is how we can use indicators to confirm what our eyes are already seeing with those zones. Here, from Swissquote, we see examples of moving averages and Bollinger Bands overlaid right on a price chart. Technical traders use these specific mathematical indicators to discover and, more importantly, confirm their trading opportunities. It's a bit of an art form, but these tools really help validate your overall strategy.
To zoom out for just a second, when you're staring at a chart, you're usually engaging in one of three types of market analysis.
Fundamental analysis looks at the big picture, political and economic situations, like elections or interest rates. Sentimental analysis looks at the overall mood or feelings of the market participants. And technical analysis, which is what we just looked at with those zones and bands, relies purely on historical price action and chart patterns to figure out where the market might move next.
As you track those market movements, you're going to be dealing with a measurement called pips. Notice how pips are visualized here to track price movement in the Forex market. The chart plots trade values over time, and whether your trade moves 10 pips, 20 pips, or 30 pips, this visual tracking is exactly how you measure your success and set your profit targets. It's the standard unit of measurement.
Finally, we arrive at Section 4, Mastering Risk and Psychology. This is all about mastering your own mindset.
I really want you to read this quote from Jeffrey Benson carefully. Strategies are everywhere. Execution is rare. Honestly, it is incredibly true. So many beginners get completely stuck thinking they just haven't found that magical holy grail strategy yet. But listen, traders rarely fail from a lack of strategy. They fail because they lack the discipline to consistently execute the strategy they already have. The market rewards discipline, not just raw intelligence.
And that discipline starts with two foundational tools, the stop loss and the take profit. A stop loss is an automatic order that cuts your losses if the market moves against you. You set a specific point where you essentially say, okay, I agree to be wrong here, and it automatically stops the bleeding. A take profit is the exact opposite. It automatically secures your gains when the price hits your target, locking in your money even if you're completely away from your screen.
So the crucial point is knowing exactly how to input these orders. Looking right here at this order screen, you can see precisely where to type in your stop loss and take profit numbers when you are first opening up a trade. You calculate these numbers based on a risk to reward ratio. For instance, maybe you choose to risk 23 pips on your stop loss to potentially gain 50 pips on your take profit. You just set them and then you step back and let the platform do the heavy lifting for you.
And here is a really fantastic pro tip directly from SwissQuote. In less volatile markets, you can explore using what's called a trailing stop-loss order. Unlike a regular stop-loss that stays rigidly planted in one place, a trailing stop-loss actually moves with the price in the direction of your take-profit order. It is a brilliant way to further reduce your risk and lock in incremental profits as the market moves in your favor.
Let's move to and see how this builds into our own mindset. Look at this statement. Discipline in taking profits is psychologically difficult for many traders. It sounds totally counterintuitive, right? I mean, why on earth would securing your own money be hard? But it's true. The psychological greed of thinking, oh, it might go just a little bit higher, often causes beginners to hold on way too long. And unfortunately, that can turn a winning trade right back into a losing one.
Which leaves us with one final, very real question for you to ponder before you start clicking any buttons. Are you psychologically prepared to stick to your rules and avoid overtrading? Seriously, are you ready to accept a loss and just walk away, without falling into that toxic trap of revenge trading? The digital tools are all there, the market is waiting. But your success? Well, that will ultimately come down to your own mindset and your own discipline. Thank you so much for joining me on this explainer. Stay disciplined out there and happy studying.